through this, so let's see how it goes today. Forward-looking statements, and that's the next slide, please. So the Fed's meeting today, and tomorrow, they're going to start trying to figure out where they go next with the economy. And the challenge for the Fed is threefold. Monetary tightening is working. Inflation has come down quite a bit. It was at as high as 9% June of last year. It's come down now to around 3 and change. So that's happening. But the economy is also slowing, but it's still solid. And usually when you have this kind of challenge on the economy, you'd see a bigger slowdown, and the strength of the economy is a bit surprising. And part of it is because we've artificially destroyed the cycles of the market. We've taken cyclicality out by both fiscal and monetary policy for the last 15 years, and now we're starting to put it back in, and we're adjusting to that, but that's really the challenge. So next slide, please, Nessa. So the Fed's job's not done, to be sure, and these are two quotes, one from Jerome Powell and one from Isabella Schnabel of the ECB. And basically what they're both saying is they don't think rates are going to go up much more from here, that we're at restrictive enough levels to slow the economy down, and you're starting to see that happen around the world. But it doesn't mean that you should be thinking that rate cuts are going to come quite as fast as the market's saying. And to put it in perspective, just how the market gets this right or wrong, at the beginning of the year, the markets were expecting a 66 basis point move in the Fed. They went 150. The Eurozone, they're expecting 141. It went 250. The UK, they're expecting 159. It went 225. So the markets have gotten this more wrong than they've gotten right. But the point from the central bankers are that if we're sufficiently restrictive, that rates aren't going up higher from here or much higher from here, that means that you have a better sense of where valuations are and where you can start putting money to work in a much clearer fashion. So if we go to the next slide, please. So I want to take this from two perspectives. I'm going to add a third country in that I didn't list here, but on one side, you have the Federal Reserve with reasonable growth going on, stronger than most of the rest of the world, certainly most of the developed world. The ECB, you have ongoing economic weakness, although there may be some signs of bottoming. And in China, you have an economy that's in transition and is struggling, but I think is getting closer to the bottom as well. But you have a very different setup for the US versus the ECB in China. The ECB is going through some transitions that they need to go through from an industrial base, how they're growing and how they're dealing with their energy problems. It's changing the nature of their economy. Throw into that a war and the other issues that are going on, and also some of the fiscal challenges that each country's facing. And you have some real growth challenges in the intermediate term and nearer term. In China, you have the big transition from an export-led economy to a consumption-led economy. But the challenge with that right now is that so much of the consumer counting on them were being driven by property values, and the wealthy have seen a big hit in their properties. Therefore, they're less likely to make investments right now. So the economy is a part of the problem for them, and the social safety nets, or lack thereof, it's going to make it tough for the government to get the consumption that they need to push the economy forward. So it may require the government to make some kind of reverse in their programs for fiscal policy and go back to the old playbook to kind of stimulate growth. That's one of the challenges that you have to see, and it's a big challenge for the Chinese government. The ECB's challenge is a little bit different. China could be going to deflation. ECB is in a disinflation mode right now, which is good. It'll help get growth back on track. I don't think you're going to see rate hikes from either the Fed or the ECB at the next meeting. And I think the market is getting way too aggressive on where they think rate hikes are coming. They're saying in the ECB, maybe Q1, maybe Q2. I think it's going to be late Q2 or later. And I think on the Fed, people are talking about second half of the year. I think it may be that we might not see any cuts next year, would be the outside of our view. But I think there's probably a 25% chance of no rate cuts. And I think there's probably a 50% chance of far fewer than, I think there's almost a 90% chance that there'll be far fewer than the market's calling for right now. I think the other thing you have to keep in mind is the balance sheets are being reduced for both the ECB and the Fed. And that's taken about almost $3 trillion of money out of the global system. That's tightening up money supply, and that's putting further strains on the system as well. So that's something we're going to have to keep an eye on. So I'm not in the mode where the street is, where they think rate cuts are coming fast. We're going to get a bailout from that. I do think if we start to see rate cuts in the second half of the year, that will offset some of the problems that we're going to have globally from the series of elections that we talked about in the last couple of weeks, that I think politicians will do the wrong thing for the economy in the near term to get reelected rather than do the right thing and not get reelected. That's an aside. Next slide, please, Anessa. So the Fed's challenge is a little different. You've had an incredibly strong labor market, and you've had the surprising strength of the consumer in the face of some of the challenges we've talked about, and you get massive support from the government and corporate spending, some of which is under question right now, either due to higher rates or due to the government problems of the US right now with Congress. I do think the other positive is AI and overall tech advances have a big opportunity to change productivity, which ironically has been down the last 3 years and is starting to turn. And if you get that turn, that's what can give you the immaculate soft landing that people are hoping for. On the other side, we do have slowing growth around the world. The US is doing okay with that. We had a big number last quarter. I think this quarter could be very low. It could be a 1% number. And I think you'll see the Fed talking about 2% numbers going into next year. So not great growth, but relative, I think it's going to be okay. I think the inflation will be lower, both what is actual and what's expected. I think that's going to help, but I don't think they're going to get to 2%. And if they do get to 2% next year, we have other problems, and you will see things starting to move around. I think that when you think about labor availability, that is a big negative. We have big shortages there. I think the productivity improvements can offset that, but if we don't get productivity right, that'll be a problem. And we have a massive debt financing problem in the US with a lot of debt coming due that we're going to have to both finance the deficit and the ongoing needs of the government. So we go to the next slide, please, Anessa. And you can see this is where the markets, the surveys of economists have been from Bloomberg. And as you can see, we started the year pretty in line with where everyone thought rates were going to go. But look where you see it starting to drop, and you see the divergence between the December and September surveys of people getting less aggressive on rate cuts. I think you'll continue to see that come through. If we go to the next slide, Anessa, please. So what's the problem? And I think you're going to hear this around the world for elections. When politicians run into problems, it's going to be the James Carville line, it's the economy stupid. It's not going to be as much about jobs. It's going to be about, do we get inflation right? Do we get the economy back on a better glide path that's more sustainable, not this fits and starts that we've had for some time. So we go to the next one, please. So we've shown this slide before, but I didn't show it in this context, which this is the proxy rate for Fed's funds, which says it's not just the Fed funds rate, it's other tightenings that the Fed can quantify. It's mortgage rates, it's quantitative tightening, it's the like. But what was surprising to me is that now conditions are higher than they were if you use the Fed proxy rate than they were in July of 2006 when we knew we had a big debt problem coming. So something to keep in the back of your minds. If we go to the next slide, please. So tightening takes a lot of forms, and it works in long lag time. So it could be 12 to 24 months before you feel the effects of it. And look at, I mentioned the balance sheet reduction from the ECB. This is the Fed. This is a really sharp move in a very short period of time. But if you go back to the great financial crisis, we were under $1 trillion. We were about 800 or 900 billion dollars on the balance sheet. We pushed it up due to 2008. And then with the pandemic, we pushed it up even higher. And now we have to get it back down to a more reasonable level. I do think this is one of the areas, if the Fed feels like they're losing control of the auctions, the treasury auctions that are going to be coming, you will look to see if the Fed has to move to reduce the 95 billion that they're cutting the balance sheet by every month, reduce that to a lower number. It means that they're having trouble financing the debt, which could push rates up higher. So this is something to keep an eye on. And that communication from the Fed is something you want to listen to going forward. Next slide, please. So the consumer's feeling some strains, and the government, the Biden administration is talking about how well the economy is doing under their watch. And the numbers say it's doing one thing, but people are, when they're surveyed, are saying something else. And the effects of cost of living, which we talked about last week, versus inflation. So let me remind you, inflation is a series number that's a point in time, 1 point over the other. It's a rate of change. Cost of living is the cumulative effect of inflation on the system. And so while inflation's coming down, consumers are now dealing with much higher costs, as you can see, from their concerns around homes, around cars, and around durables. So even though rates are coming down, the poor buying conditions, in their view, are really the overall economy, not what the administration's highlighting. And I think this is the disconnect that you're starting to see in the system. Next slide, please. The other thing that's been a major surprise, and we talked about this in previous meetings, this is how much aggregate savings had accumulated during the pandemic period. And but we've already spent 1.8 trillion of it. So if you go to the next slide, Anessa, consumers are still seeing excess cash of 350 billion, but they don't have nearly the firepower that they had before. And I would argue that, without knowing the exact numbers, that the availability of savings is very skewed to a very small number of people that make this a little misleading for how you think about this from the strength of the consumer. Because we know the low-end consumer spends everything they have. The high-end consumer has a lot of discretion, and the middle class is really strained right now. And I think that's the shift that we have to keep an eye on. Next slide, please. So I'll close with this slide. This is from Mohammed Al-Arian, and I think he's in line with our view of, or we're in line with his, either way, that the Fed's done raising rates, but I think the market needs to be really careful about how aggressive they think the Fed's going to move, because I think their economy has to have a better, more sustainable path. And I think the Fed wants to get away from the market not clearing that it needs to clear. If the Fed bails it out every time there's signs of any stress, you end up with more zombie companies and less productivity in the economy, because you have a lot of wasted assets. And I think we need to get past that, and we need some clearing out. And I think that will start, and part of the way it starts is by not having the aggressive rate cuts every time there's some fears that we might have a slowdown. And I think that change is going to come. So I'll stop there, and we can open up for discussion, Mark.
Sounds good. Thank you again, Stephen.
You're welcome.
Questions, comments?
Steve, can you share this in the chat, in a PDF?
Sure. Yes.
I have a media spot at noon, and I plan to plagiarize with appropriate attribution to you liberally.
It would be plagiarized multiple times by the time it gets.
I always attribute to you.
Mark, I understand you did a shout out to 361 from 15 Hudson Yards. How do I get a copy of that?
We did. I can if I can find it while we're all still on, I'll pop it in the chat.
Okay, great. Paul and Jim.
Oh, hey, thanks, Mark. Thanks, Stephen. Hey, one thing that we were having this debate on a Twitter Spaces this morning. I just put it in the chat there. Just like, and I stole this from Jeffrey Gunlock from Double Line. He's kind of always theorized. He says, you don't even need the Fed. You don't need the Fed funds rate. You just follow the 2-year. The 2-year is the Fed funds rate. It's just, it always leads before the Fed starts raising, and then it leads down. It turns before the Fed turns. And I'm not saying that we're going to see rate cuts, but the 2 years turned. The 2-year rate has turned, kind of mid-October. And it matches pretty well going back. The 80s are kind of a little noisy, but everything else like 90 and 1990 and forward, it kind of ties pretty well that the 2-year raises before the Fed raises, and then the 2-year rolls down before the Fed rolls down.
So
why may this not work right now? Maybe is the question, because it sounds like you're saying, hey, and I agree. It looks like rates should stay higher for longer. And I think that for a couple of reasons, but one of the reasons may just be that inflation is not really being measured properly for a lot of different reasons. But why may this not work anymore?
I'm sorry, why does what not work anymore?
Do you think the 2-year is kind of showing that, rates have turned, so the 10-year, the Fed funds rate should start going, it's like a 6-month lag they have. Do you think that this indicator may not work anymore? You're saying higher for longer?
I think you have to be careful using any one indicator for what's going on in the economy at any point in time. Gunlock, I actually have his views in front of me. He thinks the economy will soften and interest rates will decline in the short term. However, over the medium term, rates will rise due to massive federal deficits and sovereign debt. As support, he suggests 5 years from now, 50% of tax receipts will be needed to pay federal interest. So he's seeing something on the short side, but you got to watch the long end. So I always, when I hear the talking heads, try and keep it in context. On the other hand, you have Hosington and those guys who are really, Lacey Hunt, really smart guys. They're in the view that, to put it in perspective, their duration of their bond portfolio is 18 years. So I think they believe rates are going down. And then you have Druckenmiller on the other side, who believes that with our problems at the government and the mess that we've made with fiscal spending, that we're going to have the yield curve really take off on the wrong end and start to see rates rise. And he's very bearish on long treasuries. 3 really smart guys, very different views of the world. So I think you have to keep it in perspective.
Yeah. I mean, I just think, you have to watch the treasury auctions a lot closer now because of that's where you're going to see the effect of demand and where rates are going to go. But thank you.
That's the big one for us for next year is the how the treasury auctions go is going to be a big part of which way rates go, because we need to finance a lot of debt next year.
So Michael Hammer, you took yourself off mute into mute. Now you're off.
Sorry. Great presentation, Stephen. Boy, so many questions. When I look at these sorts of things, I'm looking ahead at surprises rather than what's currently going on. And we just saw a Norwegian tanker, the Strinda, hit by a missile near the Red Sea. And the Houthis have said they're going to be more aggressive. And this may seem digressing, but 10% of world trade passes through that area. And the Houthis have said they're going to get more aggressive in attacking ships. Now, the oil markets are actually down this morning by almost 3%. And it just seems that people are sanguine about these sorts of things. And, this impacts inflation potentially, what interest rates will be. So what are your thoughts on what I've just said?
I think you're 100% right. I think what happens I'm worried, to be honest with you, I'm more worried about what's going on in Europe and whether Europe continues to support Ukraine against Russia than I am about what's going on in the Middle East, because the proxy wars go on all the time. They're elevated right now, but they still have been fairly well contained. I'm not sure who's containing it, but somebody is doing a pretty good job of not having it get even worse there. And don't get me wrong, I think what's going on is awful and tragic in every way. But I think that area could blow, and that could take you a different way too. So when I'm talking about the outlook, it's if everything stays fairly constant. I think the Russia and Ukraine and what's going on there is a big issue. And you add to that, as you said, trade is being disrupted in a lot of different ways. That's one of them. And I think that is going to be a problem. And I think you have to drive defensively because of that. I also think the policies that are going to be put in place, that the right policies will not be put in place because people are going to try and get reelected next year. And we talked about all the big elections coming. And I think they're going to pander. And I think we'll do the wrong thing more often than not for the politicians. So I think that's the risk. I think you're on to big risks for the system. I think the debt financing and the geopolitics and the domestic politics in the US are the big ones. What is helpful, I think, for geopolitics, if I'm Putin and President Xi, I'm waiting for the US election next year. before I decide what I want to do next. Because the outcome of that could give them a chance to go in different directions.
You don't think that they're going to engage in acts that may affect the election?
Oh, I didn't say that. I think they do it. They do it. I think we do it. So I think everyone does it. Is it going
Not
to be
gonna
worse?
wait.
You know, who knows?
Okay. Jim, are you gonna keep us going down this rabbit hole, or are you gonna give a different direction?
Different direction. Well, I think it's a different direction. Stephen, bankruptcies appear to be rising, but credit markets don't seem to be showing any strain. Do you have observations about what's going on there?
I think the rates coming down as much as they have actually taken a lot of people off the hook for now. I don't think they've solved the problem. I think we're going to see bankruptcies continue to go up. I also think you'll see M&A pick up, which will save some of these companies because there's some good stuff in badly indebted companies that they have to figure out how to get to. But I think you will see the strains on the system continue to go. But you've had a 70 basis point drop in rates in a very short period of time, which takes a lot of pressure off some of the more highly indebted companies. So I think it's going to be a race against their revenues for them.
Stephen, unrelated, what do you think of the initial offerings market? Do you see that slowly?
It's interesting. I think the pickup of what's going on in the energy space could really you're starting to get mega deals back. I think you can start to see that spread to other industries. And it wouldn't surprise me if over the next couple of years, you see more of the fossil fuel providers merge with the renewable providers.
Mm-hmm.
Where you get the benefit of the data.
Talk about interesting bedfellows.
Mm-hmm.
Bill Deichler.
Well, while he's coming on, Vanessa, could you put the deck into the chat, please? I'm still having trouble.
She's gone.
Oh,
but I can do it.
Oh, here. No, sorry, Mark.
good.
I'm off camera, but back
Okay.
on video. So yeah, Stephen, really interesting stuff. And Paul, you make some good points about the decline in the 2-year, and even to go further, it's been like if you look at the decrease in rates, it's across the board except for the very short end. So here's sort of an interesting situation, because 6 months ago, rates were down like another, I don't know, 50 to 70 basis points across the curve, but the very short end remained high above 5%. So could we still see that kind of a situation going forward, where we see this sort of massive inversion, but the vast majority of rates at better levels? Question mark.
I think you could, but I think a lot of that will depend on how the Fed auctions go, because if they can, they'll stretch it out further. They've gone too short and they have to lengthen the maturities, but it's tough in this environment to do that. So they have to kind of gradually move out. I think the demand's going to be higher on the shorter end for the near term, but the supply is going to be higher too. So I think these auctions are going to be one of the keys to watch of what the uptake is, and the participation rates have been fairly weak. So I think that's something we're going to have to keep an eye on.
Right.
There was a question in the chat that I want to answer for Britt, which is the disconnect with the consumer sentiment and the economy. What would it take to make that shift? And I think it really comes down to wages. Wages need to catch up to the cost of living. The cost of living has been growing at a 20% rate over the last couple of years. Wages are not growing that fast, and you need to get the consumer to feel more confident. The other thing is those 3 numbers I showed on housing, cars, and durables are going the wrong direction. So if you see the consumers' trouble with buying those continuing to rise, then that's where the disconnect it really exists. If you're paying for stuff with real dollars at a 20% higher rate, your wages only went up 3 or 4, that disconnect has to resolve itself before you get the consumer feeling more confident. I'd also add Washington DC has done nothing to help with that. They're doing nothing to help confidence. I think that's the other part of it.
So just before you, Adam, Bill Deichler is leading survey number 15, and thank you, Bill, for submitting your draft. I will get back to you. We'll get that out.
You're welcome.
Great data in that every time too. Thanks, Bill.
And thanks to the community. To you, Adam.
Stephen, thank you. Great presentation. Regarding consumer confidence, I've got two questions related to that. And that is the savings rate. And you kind of touched on this. You said it's skewed to a small group of people. That's one question. What is that small group of people? I'm assuming these are the baby boomers.
The 1%ers.
Yeah. And baby boomers who have trillions of dollars that are being transferred.
Yep.
The other question is the labor market, the strength of the labor market. What is the profile of that strength? Is it more towards the service industry, more towards hospitality? Those are my two questions.
A lot of the strength in the last report was due to strikers coming back to work, and also to some government employees and some retail and leisure, I believe. But I don't have all the numbers, but a big part of it was the strikers coming back and some government stuff. So I think I think the numbers can be misleading there too. I think I think we have tight labor markets, but it wouldn't surprise me to see it continue to soften. I think companies are going to, Hasbro laid off 15% of their workforce. It's only 900 people, but it's kind of a sign that that's a consumer toy company. But you're seeing more and more of these, small layoffs, companies not filling openings, things like that could start to push up the labor unemployment rate. I think we need it. This is kind of crazy, but I think the economy needs to have some softening in employment to take some of the pressures off the system too. Productivity has to improve for that to work. Mark, if you put your email into the system, I'll forward you the report. Mark, who's next? Zarin?
Zarin's next. Yep.
Yes, I'm
Zarin,
maybe changing.
You look like this dark force in the universe. You have shadows and just so you know.
She's trying to get a trip up to space with Jane.
Yep.
Yeah, maybe why not?
She'll be in Zurich, by the way. You can talk to her.
Okay, that will be good. So maybe I'm changing the subject a little bit. We talked before about OpenAI and Microsoft, and there was just an announcement that Microsoft's interest in the OpenAI is not in the traditional stock investment, but more economic interest. So because there are a lot of restrictions and regulations when you actually own the stock, but they have more the economic interest, and there's a cap and there's a deal associated with it. So I found that interesting that they have a special way to invest without having to report the percentages, etc.
Yeah, I think the big tech companies are looking at things that are in the sights of regulators and antitrust people and thinking, how do I position myself to access some of these new opportunities? Some will be straight up acquisitions, and others will be through economic interest type of arrangements. But I think OpenAI being so controversial maybe had their government policy people thinking we should move carefully here. So
yeah.
Interesting take though. Thank you.
So Aurora, is this your first official question on our Tuesday briefings?
Yes. Thank you, Mark. Thank you, Stephen. It was great presentation. I don't really, not really a question, but more like a comment and maybe discuss with you, because I remember a gentleman, I forgot who brought up the question about the 2-year futures market, right?
Paul, yeah.
So I have a thought on that. So because I trade in the market, right, every day. So my thought is because the 2-year futures has been always leading the Fed, right? Fed does look at it very often. I mean, probably every day, but anyway. So my thought, why the leading in the 2-year futures may be off a little bit. the reason is probably this generation of traders only lived after, like only started working in the environment like since the 1980s, right? So they don't know what it has been in the high inflation period. So they always, in the last 2 years, they have been underestimated Fed constantly, right? So that's my guess, because the way, anyway, so even for quant, a lot of them discuss, I talk with the people, and a lot of them, their back tests only go back 20 years, which for me, I go back like 50, 100 years, because I'm like, 20 years is not enough, because you only see basically one environment. So anyway, that's my thought. What do you think?
I think you're right. I think a lot of I think we've had an artificial market for 15 years.
Right.
And that's suppression that both by monetary and fiscal authorities of the natural flow of an economy globally and domestically has skewed a lot of the thought process. And I think people are going to be misaligned with where they should be. I think everyone flowed to one area. I think they're going to have to move away from that. And if you stay too long, that could be painful. So
Right.
you could see a shift in both directions. I don't think rates are going down as much. And I don't think they're going up much, but I think they're probably at a pretty healthy level for where the economy is right now.
Right. Thank you.
So Austin, your first official question here.
Yeah, thanks, Stephen, for the great presentation. Following on those comments you just made, what kinds of things do you think we would need to see in the economy or globally to increase the risk that rates go up significantly?
The first one is for the Fed. It's if we don't get an uptake on the auctions. If we have, I don't know the exact number, but I think it's several $1 trillion we have to refinance next year. And that alone, if you don't get the demand for that, that'll push up rates considerably, and I think fairly quickly. And don't forget, we had a 80 or 90 basis point move up and a 70 basis point move down already this year. So you could see things shift very quickly on that. I think the other issue is, war is going to move rates if, depending on how things escalate. I think Michael Hammer was right. If you underestimate the geopolitical risks that are out there, that's one. And I also think, all these big national elections coming up is another one. And then I'm worried about the Eurozone, even though it may be bottoming. I'm not sure how they keep it together with the financial and political strains that exist today,
Sure.
which are increasing the social strains.
Just to follow up on that, can you comment on who is currently buying up the Treasury debt, where the appetite comes from, or where it might evaporate?
I think there have been a number of buyers from the U.S. for one. There's a lot of money from the U.S. is being parked in cash, so that's a big part of it. What's interesting, I looked at the numbers over the weekend on the Japanese and Chinese holdings, which everyone's worried if they start selling a lot, what's going to happen. I think China's down from a high of 1.3 trillion in 16 or 14 or 16, somewhere around there, to around 800 or 900 billion. So they've already taken it down quite a bit. And Japan's down from, I think, 1.2 to like $1 trillion now. So they're not the big case they were before. You remember when they were $2 trillion or $1 trillion each or so, we only had $10 trillion of debt. Now we're $33 trillion of debt, and they're bringing theirs down. So other buyers are stepping in. I think of some of it's from Europe because of the rate differential. I think is part of the area you're going to see it. One of the challenges, though, is the strength of the dollar and the weakness of their currencies makes that not quite the same trade. So there's been some currency arbitrage as well going on.
Thank you.
I think it's more domestic and European.
And Adam again.
No, sorry, that was my question as well. Who's buying the treasuries?
I think we have to see who keeps buying them, though, is the other thing.
Right. And
That's really the issue.
if the Chinese economy is coming back, if it's weakening, how does that impact their participation in the treasuries? Probably.
I don't think they've really been big participants for a while. So I don't think it really matters. I think what matters for China coming back is how they come back and why. I think that's the challenge. Good
I
morning.
just remember one thing I didn't announce, our last lunch of the year is Thursday in New York at ARS's offices, if anybody's in town. We always do 3 rounds. One is a round of fun facts. In Singapore, I don't know if Mo's on, but we had a new tradition was started. You write down your fun facts and you put them in a bowl. And then you pull out the piece of paper and people have to go around guessing who has that fun fact. So we're gonna see if it works in New York. It worked well in Singapore last week. So if you want to come, let us know.
I'll find
And we did it by Zoom. I don't know how that works, this game by Zoom. We had 7 or 8 Zoomers with 20 people in the room, but maybe if you Zoom, you don't get to play.
Yeah, it can't work.
All right, Roger. Now you've challenged me. I have to make it work now.
Well, they can't put the name in without being identified as coming from them.
We can figure it out. Maybe I will be the keeper. I'll be the one person who knows. Michael Hammer.
So,